If you're an investor, you're facing one big fundamental challenge. How do you make your money grow, really grow, without taking on some kind of catastrophic risk? Well, lucky for us, the legendary investor Benjamin Graham gave us a timeless way to think about this, and he offered two very different paths to building wealth. Now get this. This quote is from Sir Francis Bacon. We're talking over 400 years ago, and it just nails the problem. It's like he's saying, look, if you play it way too safe, you're probably never going to get rich. But if you're a daredevil chasing every crazy bet, you're going to end up broke. It's the classic tightrope walk between safety and growth. So that's the big question, right? How do you actually solve this puzzle? Benjamin Graham, who was basically the father of value investing and Warren Buffett's mentor, he didn't give us just one answer. Nope. He gave us two. Two completely separate paths, built for two very different types of people. All right, let's dive into that first path. This is the one Graham thought was right for pretty much everyone. He called it the defensive approach, and the idea behind it is beautifully simple. Just own everything. You know the story, right? It's what you see in the movies, what you hear about at parties. Everyone's on this treasure hunt, trying to find that one magic stock, the next Microsoft, the next Amazon, that's going to make them rich overnight. We all feel that pull, that temptation to find the one big winner. The humorist Will Rogers just brilliantly summed up how absurd this is. It's hilarious, right? If it don't go up, don't buy it. I mean, trying to pick stocks with a perfect crystal ball is completely impossible. It's a game that almost nobody can win consistently. So Graham's idea was, well, it was totally different. He said, forget spending all your time and energy digging around for that one magical needle in the giant haystack of the stock market. Just buy the whole haystack. And today, we have the perfect tool for doing just that, the index fund. Just think of it as a super low-cost basket that automatically holds a tiny piece of every important company out there. When you own the whole haystack, you are guaranteed to own all the winners, the super stocks, without ever having to guess what they'll be. It's simple, it's effective, and it takes almost zero effort. Okay, so that's path number one, simple, effective. But what if that's not enough for you? What if you want more than just average market returns? Graham knew some people are wired that way. And for them, he laid out a second path, a much, much harder path. This one's for the enterprising investor. Their goal isn't to just keep up with the market, it's to beat it. And when you put them side by side, the difference is just, wow, it's stark. The defensive investor, their main goal is just to avoid big mistakes. They buy the whole market with an index fund and maybe check on it for a few minutes a month. But the enterprising investor, they're on a totally different mission. They want to crush the average. Their method is to hunt down unpopular bargains, and that means putting in hours of work every single week. It's basically a part-time job. But this brings up a really, really important question. I mean, we see study after study showing that most professional fund managers, people who are paid millions to do this full-time, can't even beat a simple index fund. So what chance does a regular person have? Well, here's why it's so incredibly tough. First off, you're not playing this game alone. You are competing against thousands of other brilliant, highly motivated analysts. And all their research, all their knowledge, it gets baked into the stock's price almost instantly. So to find a real bargain, it's not enough to find a good company. You have to find a good company that everybody else has either missed or totally written off. You have to be willing to be a contrarian. Now, Graham didn't just point out how hard it was and say good luck. He actually gave the enterprising investor a toolkit. For anyone willing to put in the work, he laid out a very specific, disciplined set of rules to help them hunt for these undervalued companies. Now, this isn't some magic formula, okay? Think of it more like a strict safety checklist. First, he wanted strong finances to make sure the company wasn't about to go belly up, then stable earnings and a solid dividend history, which proved the company is a consistent moneymaker. But here's the key, a moderate price. By looking at things like the price to earnings and price to book ratios, he was basically asking one simple question. Am I getting a good deal on this business based on what it actually owns and earns? This whole checklist is about finding quality without overpaying for it. So where do you even start looking for these kinds of companies? Well, funny enough, you often find them in the graveyard of yesterday's hot stocks. Think about the dot-com bubble. Companies like Qualcomm and Maxim Integrated were the darlings of the market, right? Then the bubble burst, and nobody wanted them. But for a value investor, that's when they suddenly looked amazing. Financially strong, tons of cash, and trading at a huge discount. Their stocks had gone ice cold. And that right there is really the heart of this whole enterprising approach. You're looking for value where everyone else just sees disappointment. It takes a ton of patience and the guts to buy when everyone else is screaming sell. You're looking for great businesses that have simply fallen out of fashion. So this all brings us back to the main event, this central choice. We've gone through two completely different ways of thinking, two very distinct paths to building wealth. The big question now is, which one of these investors are you? I love this quote from Emerson. He's talking about keeping your independence, even when you're surrounded by a crowd. And it perfectly captures the mindset you need, no matter which path you choose. Whether you take the simple path and just tune out all the market noise with an index fund, or you take the hard path and courageously bet against the crowd, both demand an independent mind. Look, at the end of the day, this choice has nothing to do with how smart you are. It's all about self-awareness. It's about being brutally honest with yourself. How much time do you really have to give? Do you have the emotional stomach to go against the herd? What are your financial goals, really? Success doesn't come from picking the more glamorous-sounding path. It comes from picking the path that actually fits you. So I'll leave you with that one simple, powerful question from Graham, framed in his great metaphor. Are you a needle hunter ready to start the difficult search for those hidden bargains? Or are you a haystack owner, choosing the simple, proven path of owning it all? Your answer to that question will define your entire journey as an investor.